A lease looks like a simple piece of paper. A tenant's name, a rent figure, a start date, and an end date. But that single document is, in almost every sense, the real asset. The building is concrete and steel. The lease is the promise that turns concrete and steel into income. And promises, unlike concrete, can weaken over time.
This is the part of industrial real estate that rarely gets discussed with the same enthusiasm as a glossy cap rate or a striking facade. Tenant risk, lease structure, cash flow durability. These are quieter subjects, but they are usually the difference between an investment that performs for a decade and one that quietly disappoints. Start with the most basic question an investor can ask about any leased property. Who exactly is paying the rent?
It sounds almost too simple to matter, but tenant identity shapes everything downstream. A large, well-capitalized logistics operator with a national footprint carries a different risk profile than a small regional distributor operating on thin margins. Both can be perfectly good tenants, but they are not the same kind of income. This is where tenant credit analysis begins. Investors look at financial statements when available, payment history, the tenant's position within their industry, and increasingly, their exposure to disruption, whether from e-commerce shifts, supply chain restructuring, or changes in their own customer base. A tenant that looks stable today can become fragile quickly if their business model is under pressure.
Consider two buildings of similar size and location, each around 100,000 square feet, each renting for roughly $8 per square foot on a triple net basis. One is leased to a national third-party logistics operator, generating several $100 million in annual revenue. The other is leased to a regional trucking company running a handful of routes. The rent roll shows the same number on both. The risk underneath it does not match. Once tenant quality is understood, attention turns to the lease itself, the actual document governing that relationship. And here, several details matter far more than most newcomers expect. The first is lease term. How long is the tenant committed to stay? A 10-year lease with a strong tenant provides a long runway of predictable income. A 2-year lease, even with the same tenant, introduces a much shorter horizon before the investor must think seriously about renewal or replacement. Closely related is the concept of weighted average lease term, often shortened to WALT. For a property with a single tenant, this is simply the remaining lease length. But for a building with multiple tenants, WALT blends the remaining terms across all of them, weighted by the rent each contributes. A distribution center with an average lease term of 7 years typically commands a tighter cap rate, sometimes half a percentage point lower than a comparable building averaging 18 months, even when today's total rent is identical. The second critical detail is rent escalation. Most industrial leases include built-in rent increases over time, whether through fixed annual steps, commonly in the range of 2 to 3%, or adjustments tied to the consumer price index. Escalations matter because they determine whether income keeps pace with rising costs or slowly falls behind them. A lease with no escalation clause can look attractive today and become quietly unattractive 5 years later, once operating costs have risen and rent has not. The third is renewal options. Many leases grant tenants the right, but not the obligation, to extend their lease at the end of the initial term, often at a rent tied to prevailing market rates. This sounds reassuring. In practice, it introduces a specific kind of uncertainty. An option is not a commitment. A tenant can simply let it expire and lease elsewhere, particularly if a competing building offers better terms or a more convenient location.
This is why sophisticated investors pay close attention to the notice period attached to renewal options, the window of time before expiry in which a tenant must declare their intentions.
A 90-day notice period gives an investor very little runway to find a replacement tenant if the incumbent decides to leave. A longer notice period, 6 months or a year, gives considerably more room to plan. The fourth detail, often overlooked entirely by newcomers, is the security deposit or lease guarantee. A typical deposit might equal 2 to 3 months of rent, offering limited protection against a sustained default. A corporate guarantee from a well-capitalized parent company offers considerably more coverage. The absence of either should itself be treated as a risk factor, not a neutral condition. With the lease terms understood, the conversation shifts to a subject that sits quietly behind every income projection: vacancy risk. Vacancy is, in some sense, the central risk of income-producing real estate. A building that sits empty generates no rent, while still incurring property taxes, insurance, and basic upkeep, costs that, on a mid-sized distribution center, can easily run into 6 figures annually, even with no tenant in place. The investor's return during that period is not reduced. It is negative. Vacancy risk has 2 components worth separating. The first is the probability that a tenant leaves at lease expiry. The second is the duration of the vacancy that follows, before a new tenant is found and begins paying rent. Both components are shaped by market conditions outside the investor's direct control. In a market with an industrial vacancy rate under 5%, downtime between tenants often runs 3 to 6 months. In an oversupplied market, where vacancy climbs toward 10 or 12%, that downtime can stretch well beyond a year. This is where the concept of releasing cost enters the picture. When a tenant departs and a new one is found, the incoming tenant typically expects some combination of tenant improvement allowances, often several dollars per square foot for a straightforward industrial fit-out, and leasing commissions paid to brokers, typically a percentage of the total lease value. On a 100,000 square foot building, these combined costs can run into the hundreds of thousands of dollars, and they are frequently underestimated in early-stage underwriting. A responsible investor does not simply project rent continuing uninterrupted into a spreadsheet. They build in an assumption for vacancy periods and releasing costs across the life of the investment, even when the current tenant shows no signs of leaving, because eventually they will. Tenant concentration deserves its own moment of attention, particularly for buildings leased to a single occupant. If one tenant accounts for all of a building's income, that tenant's departure does not create a partial problem. It creates a complete one. The entire cash flow disappears at once, rather than declining gradually as it might in a multi-tenant property where risk is spread across several leases. This is not necessarily a reason to avoid single-tenant properties. Many are excellent investments, particularly when the tenant is investment grade and the lease term is long. But it does mean the investor's risk is concentrated rather than diversified, and the underwriting should reflect that concentration honestly. There is another layer worth understanding: the difference between contractual rent and sustainable rent. Contractual rent is simply what the lease says the tenant must pay. Sustainable rent is what a similarly situated tenant would realistically pay for that space in today's market. When contractual rent sits meaningfully above sustainable rent, say a tenant paying $9 per square foot in a submarket where comparable space is leasing closer to $7, it can look like a bonus in the near term, but it introduces real risk at renewal. If the tenant renews at all, they are likely to push for a rent closer to that $7 market level, meaning income can step down by 15 or 20%, even while the building's physical performance stays exactly the same. The reverse condition, below market rent, carries a different kind of appeal and a different kind of risk. It suggests upside at renewal, but it can also mean a tenant who is comfortable, entrenched, and reluctant to accept a significant rent increase, potentially prolonging a negotiation or increasing the odds they choose to relocate rather than pay the adjustment. All of this feeds into a single practical exercise every serious investor performs before acquiring a leased property: cash flow stress testing. A base case model assumes the current lease runs its course, the tenant renews on reasonable terms, and cash flow continues largely uninterrupted, often producing a projected return in the range of 8 to 9%. This is the scenario most sellers prefer to present, understandably. But a base case is not a risk assessment. It is a single, optimistic outcome among several possible ones. A stress test asks harder questions. What happens to returns if the tenant does not renew? What happens if the building sits vacant for 6 months or 12 before a new tenant is secured? What happens if the replacement tenant only agrees to a rent 10% below the prior contractual level? Once these adjustments are layered in, that same 8 to 9% projected return can fall to 4 or 5% or lower in a downside scenario.
None of these questions are meant to produce pessimism for its own sake. They are meant to produce honesty. An investment that only performs well under the most favorable assumptions is not a resilient investment. It is a fragile one wearing a favorable disguise. This same logic extends to how lenders evaluate these properties, and it is worth understanding because financing terms are shaped directly by lease and tenant quality. Lenders typically size loans around a debt service coverage ratio, commonly requiring the property's income to exceed debt payments by a factor of at least 1.25. A property leased to a strong tenant on a long-term lease with healthy escalations will generally support a higher loan-to-value ratio and a lower interest rate than an identical building leased to a weaker tenant on a short-term arrangement, even if the current rent figures are the same. Lenders are, in effect, underwriting the durability of the income stream, not merely its current size. This is why two buildings with the same net operating income today can command meaningfully different values, sometimes a difference of a full percentage point or more in cap rate, which on a $10 million building can mean well over $1 million in valuation. There is one more dimension worth understanding before drawing this together: the difference between a lease and a sublease. In some structures, particularly with larger corporate tenants, the named tenant on the lease may not be the party actually occupying and operating from the space. They may have subleased some or all of it to another company. This matters because the investor's contractual relationship remains with the original tenant, even though the operational reality on the ground may be entirely different. A careful investor identifies who is actually running operations inside the building, not simply who signed the original lease. Bringing all of this together, a mature view of tenant and lease risk does not treat any single figure, not the rent, not the cap rate, not the remaining lease term, as sufficient on its own. It treats the lease as a living document, describing a relationship, one that carries its own credit risk, its own renewal uncertainty, and its own eventual expiration, no matter how strong it looks today. The investors who perform well over a full market cycle are rarely the ones who found the highest headline yield. They are the ones who understood before signing exactly what kind of promise they were buying and exactly what would happen the day that promise came due. This is Trov Estate. A lease is not the end of the analysis. It is where the real analysis begins.